the retirement tax bomb hiding in your IRA and 401k. This is a warning about required minimum distributions. Let me start with a scenario that might surprise you. Imagine two neighbors. We'll call them John and Susan. Both are 70 years old, both have $800,000 saved for retirement, and both need $60,000 per year to live on. John pays $22,000 per year in taxes and Medicare IRMAA surcharges. Susan, she pays only $7,000. Same income, same savings, but John is paying $15,000 more every single year. Over a 20-year retirement, that's $300,000 gone. The difference isn't what they have, it's how they're taking it out. Welcome to Retirement Security Simplified. I'm Shonda Prescott, and I help pre-retirees and retirees create tax-efficient income strategies. Most people spend decades accumulating money for retirement, but very few spend enough time planning how to get that money out in the most tax-efficient way possible. Today, I'm going to walk you through the exact strategies that can help you keep more of your hard-earned retirement savings. We'll cover the 3 tax buckets you need to understand, the hidden tax traps waiting in retirement, and the specific strategies to minimize your lifetime tax burden. If you're within 10 years of retirement or already retired, this video could be worth tens of thousands of dollars to you. Let's dive in. The foundation of tax-efficient retirement planning is understanding what I call the 3 tax buckets. Every dollar you have saved for retirement sits in one of these 3 buckets, and each one is taxed completely differently. The taxable bucket. This is money in regular savings accounts, CDs, brokerage accounts, and bonds. You've already paid taxes on the money you put in, but you pay taxes every year on any interest, dividends, or capital gains you earn. For example, if you have $100,000 in a CD earning 4%, you get a 1099 for $4,000 of interest income every single year, whether you need that money or not. That $4,000 gets added to your tax return and taxed at your ordinary income rate. The tax deferred bucket. This includes traditional IRAs, 401ks, 403bs, and similar retirement accounts. You got a tax deduction when you put the money in, and it grows tax deferred, meaning no taxes during the accumulation years. But here's the catch. Every dollar you take out is taxed as ordinary income. If you withdraw $30,000 from your IRA, you'll pay tax on the entire $30,000. And at age 73, the IRS forces you to start taking money out whether you want to or not. These are called required minimum distributions, or RMDs, and we'll talk more about those in a minute. The tax-free bucket. This is the holy grail of retirement savings. Roth IRAs, Roth 401ks, and health savings accounts used for medical expenses. You pay taxes on the money going in, but then it grows completely tax-free, and qualified distributions come out tax-free. That means if your Roth IRA grows to $500,000 and you withdraw $30,000, you owe 0 taxes on it. It doesn't count towards your taxable income, doesn't affect your Social Security taxation, and doesn't trigger Medicare IRMAA surcharges. Now, here's why this matters so much. Having money in all 3 buckets gives you the flexibility and control over your taxes in retirement. You can strategically choose which bucket to pull from based on your tax situation each year. The biggest mistake I see is people who have 80 to 90% of their retirement savings in tax-deferred accounts like IRAs and 401ks. They've created a ticking tax time bomb because they have no choice but to take money from accounts where every dollar is fully taxable. Think of it this way. If all your retirement money is in a traditional IRA, you're in a canoe with only one paddle. If you have money diversified across all three tax buckets, you've got multiple paddles and you can steer around tax obstacles much more easily. The goal is tax diversification, spreading your retirement savings across these three buckets so you have maximum flexibility to minimize taxes throughout your retirement. Now, let's talk about the tax traps that catch most retirees by surprise. These are the things that can turn a comfortable retirement into a tax nightmare if you're not prepared. Trap number one: required minimum distributions. Starting at age 73, the IRS requires you to withdraw a percentage of your tax deferred accounts every year. These are required minimum distributions, or RMDs. That percentage starts at about 3.8% at age 73 and increases every year as you get older. Here's why this becomes a trap. Let's say you've been a great saver and you've accumulated $1 million in your traditional IRA. At age 73, you're required to withdraw approximately $38,000. At 75, it's about $40,600. At 80, it's around $53,000. But here's the problem. Maybe you don't need that much money. Maybe you're living on Social Security and a pension. But the IRS doesn't care. You must take the distribution and you must pay taxes on it. I call this the RMD Tax Bomb, and I've seen it destroy retirement plans. I had a client who came to me at age 72 with $1.2 million in his IRA. He was living comfortably on $50,000 per year from Social Security and a small pension. When his RMDs kicked in at 73, he was forced to take out an additional $45,000 he didn't need. That extra $45,000 pushed him into a higher tax bracket, made 85% of his Social Security taxable, and triggered Medicare IRMAA surcharges. What should have been a simple $50,000 income situation turned into a $95,000 taxable income nightmare. Trap number two: Social Security taxation. I covered this in detail in my Social Security optimization video, but here's the quick version. Up to 85% of your Social Security benefits can become taxable based on something called provisional income. The thresholds are incredibly low. For married couples, if your provisional income exceeds $44,000, up to 85% of your Social Security becomes taxable. And remember, those RMDs we just talked about, they count towards provisional income. Trap number three: Medicare IRMAA surcharges. IRMAA stands for Income Related Monthly Adjustment Amount. Once your modified adjusted gross income exceeds certain thresholds, $106,000 for single filers and $212,000 for married couples in 2025, you pay additional surcharges on your Medicare Part B and Part D premiums. These surcharges can add $1,500 to $6,000 or more per year to your Medicare costs. And they're based on cliff brackets, meaning one extra dollar of income can cost you over $1,000 in additional premiums. Trap number four: the widower tax penalty. This is the one people rarely think about, but it's devastating. When you're married, you file jointly and benefit from wider tax brackets. The 22% tax bracket for married couples in 2025 goes up to $201,050. But for single filers, that same 22% bracket only goes to $100,525. So when a spouse passes away, the surviving spouse loses the married filing jointly status. Suddenly, they're filing single, which means their tax brackets are cut roughly in half, but often their income doesn't decrease proportionally. especially if they inherit retirement accounts or continue receiving survivor benefits. I've seen surviving spouses go from the 12% bracket to the 24% bracket overnight with the same approximate income. The real problem is when these traps hit all at once. You've got RMDs forcing money out of your IRA, which makes more of your Social Security taxable, which triggers IRMAA surcharges, and if you lose a spouse, you're dealing with higher tax brackets on top of everything else. But here's the good news. Every single one of these traps can be minimized or avoided with proper planning. And that's exactly what we're going to talk about next. One of the most important decisions you make in retirement is the order in which you withdraw money from your different accounts. This is called withdrawal sequencing, and it can make a massive difference in how much you pay in lifetime taxes. The traditional approach? The conventional wisdom says to withdraw in this order. Taxable accounts first, savings, CDs, brokerage accounts. Tax-deferred accounts second, IRAs, 401ks. Tax-free accounts last, Roth IRAs. This logic makes sense on the surface. Let your tax-deferred and tax-free money continue growing as long as possible while you spend down accounts that are generating taxable interest anyway. And for many people, this works just fine, but it's not always optimal. When to break the rules. Let me give you a scenario. You retire at 62 with $300,000 in taxable accounts, $700,000 in a traditional IRA, and $100,000 in a Roth IRA. You plan to delay Social Security until age 70 to maximize your benefit. If you followed the traditional approach, you'd spend down that $300,000 in taxable accounts first. Let's say that lasts until age 66. Now you're starting to take IRA withdrawals. But here's the problem. Your IRA has been growing for 4 years and is now worth maybe $850,000. When you start taking $50,000 per year from your IRA, it's all taxable. Then at 70, Social Security kicks in, and now 85% of that is taxable too. By 73, RMDs start forcing even more out. A smarter approach. What if instead, during those early retirement years from 62 to 70, you strategically withdrew from your IRA even though you didn't strictly need to? Maybe you take out $40,000 per year from the IRA to live on, keeping yourself in the 12% tax bracket. You're paying taxes at 12% now instead of potentially 22 or 24% later when Social Security and RMDs kick in. Plus, you're reducing the balance in your IRA, which means smaller RMDs in the future. This strategy is especially powerful when you combine it with Roth conversions, which we'll discuss in the next section. Creating income bridges. Here's another sophisticated strategy using tax-efficient income sources to create bridges during gap years. For instance, you might use a fixed indexed annuity to generate income from ages 62 to 70 while you delay Social Security. Because the annuity income is partially a return of principal through the exclusion ratio, only a portion is taxable. This keeps your taxable income lower than if taken the full IRA withdrawals, which helps you avoid triggering Social Security taxation later and keeps you below IRMAA thresholds. The key principle. The goal isn't just to minimize taxes this year. It's to minimize your total lifetime tax bill. Sometimes that means paying some taxes now in a low bracket to avoid paying much higher taxes later. Think of it like this. Would you rather pay 12% tax on $40,000 now or 24% tax on $60,000 later because of RMDs and Social Security stacking. The math clearly favors paying taxes strategically in lower brackets when you have control. Now, let's talk about one of the most powerful tax planning tools available to retirees: Roth conversions. What is a Roth conversion? A Roth conversion is when you take money from a traditional IRA and move it to a Roth IRA. You pay taxes on the amount you convert in the year you do it, but then that money grows tax-free and comes out tax-free in retirement. Now, I know what you're thinking. Why would I want to pay taxes now? Shouldn't I defer taxes as long as possible? Here's why Roth conversions are so powerful. You're trading a known tax rate today for an unknown tax rate in the future. And in most cases, especially with current tax rates, paying taxes now at a lower rate is a smart move. The sweet spot years. The best time to do Roth conversions is during what I call the sweet spot years, typically between retirement and when you claim Social Security or start RMDs. Let's say you retire at 62. Social Security doesn't start until 70 and RMDs don't start until 73. During those years, your income might be relatively low. Maybe you're just taking small distributions to live on. This is the perfect time to convert IRA money to a Roth because you can control exactly how much income you have. You can convert just enough to fill up the 12% bracket or the 22% bracket without jumping into the next one. Multi-year strategic conversions. The most effective approach is usually converting over multiple years rather than doing one massive conversion. If you have 8 years between retirement and RMDs, you might convert $50,000 to $70,000 each year, staying within the 12% or 22% bracket. Over 8 years, you could convert $400,000 to $560,000, all at relatively low tax rates. This dramatically reduces your future RMDs and creates a large pool of tax-free money for later in retirement. Critical consideration. One important point: you should ideally pay the taxes on Roth conversions from money outside your IRA. If you convert $50,000 and pay $6,000 in taxes from that same $50,000, you're only really converting $44,000. It's much better to pay the $6,000 in taxes from your checking account or taxable savings. That way, the full $50,000 goes into the Roth and can grow tax-free. The long-term impact. I had a client who did Roth conversions for 6 years during her early retirement, converting about $60,000 per year at the 12% rate. She paid roughly $43,000 in total taxes on those conversions. But by doing this, she reduced her future RMDs by more than $30,000 per year. Over a 25-year retirement, that saved her well over $150,000 in taxes, not to mention avoiding IRMAA surcharges and reducing Social Security taxation. Roth conversions aren't right for everyone, but for most people with significant IRA balances, they're one of the smartest tax moves you can make. Beyond deciding which accounts to tap, you also need to think about which types of investments and income vehicles you use. Not all income is taxed the same way, and choosing tax-efficient income sources can save you thousands of dollars every year. Fixed indexed annuities. Let me start with fixed indexed annuities, or FIAs, because they're one of the most tax-efficient tools for retirement income, though they're often misunderstood. First, FIAs grow tax-deferred. Unlike a CD where you get a 1099 every year for interest, a fixed indexed annuity doesn't generate taxable income during the accumulation phase. This is huge for managing provisional income and staying below IRMAA thresholds. Second, when you do take income from a fixed index annuity, especially if it's funded with after-tax money, you benefit from something called the exclusion ratio. This means that part of each payment is considered a return of your principal, which isn't taxed, and only the earnings portion is taxable. Let me show you a comparison. Let's say you need $30,000 per year in income. Option A, CD at 4%. You need $750,000 to generate $30,000 per year. That entire $30,000 is taxable interest. At a 22% tax rate, you pay $6,600 in taxes, netting you $23,400. Option B, IRA withdrawal. You take $30,000 from your traditional IRA. The entire amount is taxable ordinary income. At 22%, you pay $6,600 in taxes, netting $23,400. Plus, this increases your provisional income, potentially making more of your Social Security taxable. Option C, fixed indexed annuity with exclusion ratio. With an annuity funded with after-tax dollars, maybe only 40% of the $30,000 is taxable. That's $12,000. At 22%, you pay $2,640 in taxes, netting you $27,360. That's almost $4,000 more per year in your pocket. $80,000 over 20 years. There's another advantage. Many FIAs offer guaranteed lifetime income riders. From a tax planning perspective, this gives you predictability. You know exactly how much income you'll have each year, which makes it easier to plan around IRMAA thresholds and Social Security taxation. Compare that to a stock portfolio where your dividends and required distributions might vary, making tax planning more difficult. Now, FIAs aren't perfect for every situation. They're designed for long-term income, not short-term access. But for creating tax-efficient, predictable retirement income, they're hard to beat. Other tax-efficient options? Municipal bonds. These pay interest that's federally tax-free and sometimes state tax-free. However, be aware that municipal bond interest does count towards provisional income for Social Security taxation purposes, even though it's not taxed itself. Cash value life insurance. If structured properly, you can take tax-free loans against the cash value of permanent life insurance policies. This can be a tax-efficient income source, though it requires careful planning and isn't suitable for everyone. Qualified dividends. If you have a taxable brokerage account, holding dividend-paying stocks can be tax efficient because qualified dividends are taxed at capital gains. 0%, 15%, or 20% rates, rather than ordinary income rates. For many retirees in lower brackets, qualified dividends can be taxed at 0%. The key is understanding that a dollar of income from different sources doesn't have the same tax impact. A dollar from your IRA might really cost you $1.30 when you factor in federal taxes, state taxes, Social Security taxation, and IRMAA. But a dollar from a Roth IRA or properly structured annuity might only cost you $1 or less. When you're planning retirement income, always think in terms of after-tax spendable income, not just the gross number. Now let's cover some additional strategies that can further reduce your tax burden in retirement. These are tactics that can save you thousands of additional dollars when used properly. Qualified charitable distributions. Once you turn 70 and a half, you can donate up to $105,000 per year directly from your IRA to qualified charities. This is called a qualified charitable distribution, or QCD. Here's why this is powerful. The QCD counts toward your required minimum distribution, but it doesn't count as taxable income. So if your RMD is $40,000 and you donate $15,000 to your church or favorite charity via a QCD, you only have $25,000 of taxable income instead of 40. This reduces your tax bill, keeps your income lower for Social Security taxation and IRMAA purposes, and supports causes you care about. If you're charitably inclined, QCDs are a no-brainer once you're eligible. Tax loss harvesting. If you have taxable brokerage accounts, you can strategically sell investments that have lost value to offset gains from other investments. You can offset up to $3,000 of ordinary income per year with capital losses, and you can carry forward unused losses to future years. This is especially useful in volatile markets or when you need to rebalance your portfolio anyway. Asset location strategy. This is about putting the right investments in the right type of account. Tax inefficient investments like bonds that generate ordinary dividends or real estate investment trusts should go in a tax deferred account like IRAs where the income isn't taxed until withdrawal. Tax efficient investments like growth stocks that don't pay dividends or index funds with low turnover should go into taxable accounts where you can benefit from lower long-term capital gains rates. This strategy doesn't change what you own, just where you hold it, but it can reduce your annual tax bill significantly. Bunching deductions. With the higher standard deduction, $29,200 for married couples in 2025, many retirees don't have enough deductions to itemize. But you can bunch deductible expenses into alternating years. For example, instead of donating $10,000 to charity each year, you might donate $20,000 one year and nothing the next. In the year with $20,000 in donations, plus property taxes and other deductions, you itemize. In the alternate year, you take the standard deduction. Managing capital gains. Long-term capital gains have their own tax brackets: 0%, 15%, and 20%. For married couples in 2025, you can have up to $96,950 in total taxable income and still pay 0% on long-term capital gains. This means in low-income years, you can strategically sell appreciated investments and pay zero tax on the gains. This is especially useful during those early retirement years before Social Security and RMDs kick in. Health savings account distributions. If you have an HSA, remember that distributions for qualified medical expenses are completely tax-free at any age. In retirement, you can use HSA funds for Medicare premiums, long-term care expenses, dental, vision, and other medical costs without any impact. And you can actually save receipts from medical expenses paid years ago and then reimburse yourself tax-free from your HSA anytime in the future. This gives you incredible flexibility. These strategies work best when coordinated together as part of a comprehensive tax plan. Each one alone might save you a few $1,000s, but together they can save you tens of thousands over a retirement that could last 30 years or more. Let's bring this all together, because I know we covered a lot of ground today. The key insight is this: retirement tax planning isn't about the accumulation strategy. It's about the withdrawal strategy. It's not just about what you have, it's about how you get it out that determines how much you actually get to spend. Remember the 3 core principles. First, diversify your tax brackets. Having money in taxable, tax-deferred, and tax-free accounts gives you the flexibility to manage your taxes strategically throughout retirement. Second, plan your withdrawal sequence. Don't just follow conventional wisdom. Think about filling low tax brackets strategically using Roth conversions during sweet spot years and creating income bridges with tax efficient vehicles. Third, use tax efficient income sources. Whether it's fixed index annuities with the exclusion ratio, qualified dividends, Roth distributions, or QCDs, understanding how different income is taxed can save you thousands of dollars every year. Here's what I want you to understand. The difference between John and Susan from the beginning of this video, the $15,000 per year difference in taxes, wasn't luck. It was planning. Susan had a tax-efficient withdrawal strategy. John didn't. Over a 30-year retirement, we're talking about potentially $450,000 or more in tax savings. That's not money lost to bad investments. It's money lost to lack of planning. If this information was helpful, you might like the free booklet called Retire Smart. It's available on the page that's linked in the description box. If you found this video valuable, please give it a thumbs up and subscribe to Retirement Security Simplified. We publish new retirement planning content every week designed to help you make smarter decisions with your money. And I'd love to hear from you in the comments. What's your biggest concern about taxes in retirement? What strategies are you already using? Drop a comment below. Thank you so much for watching, and remember, retirement security doesn't have to be complicated. With the right strategies and proper planning, you can keep more of what you've worked so hard to save. I'll see you in the next video. This is Retirement Security Simplified, where we specialize in turning confusion into confidence, one conversation at a time.